And I say our company because my mother founded this company when I went to kindergarten. She went to Nationwide Tax Service, took a class, learned how to prepare taxes. And that year, a tax business started at our kitchen table. And my mother is just somebody who really just is all in the unicorns. For whatever reason, she's now transitioned to the ancestral realm, but I still very much call on and depend on her support and her energy. And so in describing the company, I had to just explain to people, unicorns and what does that have to do with taxes and accounting. But the bottom line is she's talking about the single-horned horse with no wings, not the Pegasus. Unicorns to her symbolize good fortune, beauty, magic, and rarity. And so she sought to be these things to the people she provided accounting and tax services to, and I seek to, in her footsteps, do the same. So Unicorn Unlimited Inc. was founded in 1983. Accounting, taxes, business consulting is the main activity of the business. I personally, Greg Mckenzie, have an MBA in accounting and finance, and I have been in the industry working professionally for the better part of 25 years. So I've had experience from the private sector to the public sector to nonprofit, small business, tax preparation for small businesses and individuals, as well as information returns for nonprofit organizations. So I've been in and out of a lot of the spaces that have to do with accounting and tax. At this moment, my family is re-entering the house. Life is real. We're moving around, transporting things. So you all may hear some background noise, just hanging there with me as we transition. But to get into what today's content is going to be, I've summarized it here in sort of like a content list. First, we're going to talk about the definition of farm as per the IRS, record keeping systems, accrual versus cash, farm income, farm expenses, and then the Schedule F, which is the document that accompanies the 1040 that farmers specifically file their income and expenses on. So publication 225 is the publication of the IRS that sort of talks about farmers and their tax realities. You can find that document here. I wish I knew how to copy and paste this and put it in the chat, but this is the hyperlink to where you can get publication 225. It's 96 pages. It goes in depth in many of the areas of this whole discussion that we're going to have today. But it's defined simply as follows. You are in the business of farming if you cultivate, operate, or manage a farm for profit, either as owner or tenant. A farm includes livestock, dairy, poultry, fish, fruit, and truck farms. It also includes plantations, ranches, ranges, and orchards and groves. I just read that definition for the first time. That bottom part, that plantation, struck me a certain kind of way. I didn't know that I was in there, but I digress. Record keeping system. Again, I'm quoting directly from publication 225, except in a few cases, the law does not require any specific kind of records. So I know sometimes people get kind of nervous about record keeping and they think that it has to be a very specific, certain type of format. Well, here, directly from the IRS, you can see that that's not the major concern. The formula that you're using to keep the records. More importantly is how it's reported at the end on the Schedule F. Record keeping can be achieved through some of the following, but not limited to these: bank statements, credit card statements, electronic money transfer statements. And by that, we're talking about Zelle, Venmo, Cash App, and all of the different ways in which money is transferred these days that are not quote unquote banks. Copies of checks, cash receipts, and many others. A note for you to be mindful of is keep your records for at least 3 years. In some instances, records are only required to be kept for 2 years, but if you keep them for 3, then you meet both requirements. So some folks keep records forever and ever and ever. You don't have to do that. They say, well, you got to keep them for 10 years. It's not the record retention requirement of the IRS. You have to keep the records for 3 years. Publication 225, again, goes into those details. Before I go too much further, jump into this, are there any questions thus far on anything that I've talked about? I know it's mostly pretty straightforward to me because I'm dealing with this information all the time, but I just want to make sure that I'm not moving past something that somebody wanted to discuss further. Okay. We haven't had any hands raised, T?
I don't think so. And I'm
Okay.
also looking at the chat.
Okay. So I'll keep going. Accrual versus cash. This is a conversation that is particularly important for the Schedule F because farm income, you have the option to account for either on the accrual basis or on the cash basis. But again, this is language that I pulled directly from the 225. I can say it in layman's terms, but what is said here is under this rule, include an amount in income on the earliest of the following dates: when you receive payment, when the income amount is due to you, when you earn the income. On a cash basis, under the cash method, including your gross income, all items of income you actually or constructively received during the tax year. So the major difference is with accrual, if somebody tenders an invoice, or if you tender an invoice to somebody, but don't receive payment on that invoice during the period before the taxes are due, you can still include that income. So if I put an invoice out for $5,000 worth of goods that I've produced, but I don't get that payment until January the 12th, I can still include the $5,000 in my income for tax purposes. On cash basis, you have to wait until you actually receive the $5,000 in order to include it in your income. So even if you presented an invoice, but you're using a cash basis for your accounting, that $5,000 is now a part of the next tax period, which will be the next year because you didn't take delivery of it or accept it constructively until that year. The same logic applies for accrual expenses. All events have occurred that fix the fact that you have a liability, and the amount of the liability can be determined with reasonable accuracy. And number two, economic performance has occurred. So you can, on an accrual basis, you can see expenses or recognize expenses the moment that you have the liability, not when you make the payment only. But on a cash basis, you only recognize the expense when you make the payment. So you might have an arrangement with somebody that you don't need to pay them for 90 days, but it's November. And they've done whatever work that you needed done or whatever services that you were getting from them. On the accrual basis, you can use that expense in that year's tax return in the current year where that November resides. On the cash basis, you won't be able to take that expense into account until you actually pay it. So that's really the difference between the two. One is real time, the other is based on invoice.
Oh, okay. Quick question. So you don't, okay, I have never seen, I've done taxes, my own personal taxes, but in terms of business taxes, you don't have to say, I'm doing it cash, I'm doing it accrual. You just show it. Is that right?
So when you do a Schedule C or a Schedule F, where we're looking at income and expenses, the accrual versus cash is that question comes up when you do those additional schedules. If you're just doing a 1040, for your own personal tax filing that doesn't have a Schedule C or Schedule F, then you don't have to get into accrual versus cash. That's more of an accounting ideology that they want to know which way are you accounting for your money, and then different rules apply based on it.
Mm-hmm. And do you have a do you have a, for small businesses, do you have a recommendation accrual versus cash?
I recommend accrual personally, because it allows you to take advantage of expenses that you didn't necessarily have to pay yet, or to include income that you didn't necessarily get to collect yet. It just gives accrual is designed to give a more accurate picture of your financial situation. Even though the money isn't there, it's really coming to you. And so in the period that it was earned is per the accrual thought process where it should be accounted for, not when you actually receive the invoice. Because we all know in the real world, generally invoices have payment terms, and those payment terms generally give folks 30, 60 days, which could easily push you into a different accounting year, depending on the timing of it. So
if I can add, I will say that the nature of kind of small farming, I think at the end of the day, they don't look that different. Like if you were to really map out your accrual and really map out a cash method, they wouldn't look that different, mostly because most of our sales are happening with fresh produce. So people are paying either at the farmer's market or it's restaurants who are paying up front, and things like that. And we're not farming much in the winter. I'm not making any sales in October, November, December, in reality. And so most of my books are all closed by the time my tax season is closed anyways. So I've kind of played around with both. And at the end of the day, they really don't look any different for my farm. And I think for a lot of other small farms. So I think in a lot of ways you just pick one and stick to it, but I wouldn't, at least on a small scale, it's not going to make or break your books at the end of the day. I think if you pick one and stick to it, you're going to be fine. It's not, I mean, you have to answer the question, obviously, so it's good to know the difference. So, and Greg explained it great, but if you pick one, you're probably not going to kick yourself later that you picked the wrong one. That's all I'm saying.
And Brittany, that was important context. Thank you for that. Because the reality is, like, the farming season is wrapping up at this time, so it's not going to be a lot of activity anyway. So accrual is really, really beneficial to you when you have high volume of activity that may slip into the next accounting period.
Right, or high inventory that you're maybe
Yeah.
selling next year, but we just in reality don't have a lot of that. So I think you could go either way.
That's a good point. This one, and even though it's a big requirement for the IRS, may not necessarily be a big issue for the farmers on this call. And I will say this, per publication 225, if you make $27 million or more with your farm, then you are required to do accrual. So that's the point in which accrual becomes a mandate by the IRS. But anything south of that, you'll find to pick between the two.
Any questions on that? Because I feel like that is a big a big point that people accrual, cash.
I know.
Go through any examples.
Yeah, I think it'll be I'm open to it if anybody wants to do that.
Okay, I have one. Okay, so we have a person who produces honey. So I appreciate you saying that, Brittany, because this gets me into inventory, right? So say they produced the honey, they harvested it, and they have it sitting. Then they make a sale. Say they make a sale, and it's like at the end of the tax year, I guess. So so I hope we can see the difference. So they make a sale, and they invoice someone for the amount of services. Say say somebody purchased 30 jars of honey, right? And they gave them to them for a Christmas giveaway, but they haven't paid them yet. So they, they send an invoice and they say, you owe me, say 5 times 30, you owe me some money, right? 10 times 30, you owe me $300. In the accrual system, as soon as they transfer the goods, that would be where they would put it on their books. So they would transfer it in December. They would put it on their books in December. Is that
That's correct.
Okay.
That's correct. When they generate the invoice, that's the moment when it becomes part of their income. And so even though they don't actually deposit cash, they do increase the assets on their books because that becomes an account receivable. That $300 is anticipated, on the date that the invoice becomes due. And so it's now already counted as an asset at $300. It's not a cash asset, but it's an asset that will be, liquidated within a 12-month period. So it's a current asset. So it's as good as cash from an accounting standpoint on their books. The moment they do the invoice, that starts to become, something in their favor. So in the accrual, it will work like that. Now, if they were cash basis, then, they, even though they did the jars of honey in December, but the person couldn't pay them until January, then they don't get the benefit of that sale during the tax year, which, let me say this, could be a good thing depending. If you had too much income and you weren't trying to pay a whole bunch of tax on it, and maybe you got more expenses in that next year, that income might do you better in that next year so that you have more expenses to subtract against it and not necessarily have to pay. And we're talking about $300, but I'm just saying, in a larger, as you scale that up, it could become advantageous to delay the realization of the income into another period where you might have more expenses to offset it.
All right. I feel comfortable for that. Anybody have a question about accrual versus cash or an example they want to talk through?
I think I have an example to ask.
Yeah, go ahead, Haley.
So if you like order seeds or compost or some kind of material in the winter for the next year, can you count that for the year that you're going to be like using those seeds and stuff with one of the methods, like with accrual?
So with the accrual, you order it, and so you order it and then they send you an invoice, right, to pay?
Yeah, well, so like, let's say I order all my seeds for next year this month.
When would you get them?
This year, I think they would, they would come within the month or something, but they would get used next year.
Yeah. So under accrual, you incur the expense when you get the merchandise or the invoice. So in that instance, you would be able to put that in that tax year, even though you're not using it until the next year. You might save some and even use them the year after, whatever. The period when you incur the expense is when you actually can deduct it from the income.
Okay, so it would just be the same with both methods.
Yeah.
Okay. I have a question. Yep, that's me, George Cole. Hi, everyone. Hi, T. I have a question. Thank you so much, Gregory, for your great presentation thus far. On the what if you're a nonprofit? If your garden, yes. And so in other words, what if you're a nonprofit and your farm, your community garden is under that premise, and you send out an invoice and you don't get paid? Well, you said it accrues, but what if you actually don't get the payment? The person, they can't pay you. Now,
they never pay?
Yeah, they never pay. Because you were saying an example.
Now that's a true nonprofit.
That's a real nonprofit, right? It's like it's gonna be zero coming in. Okay, and they don't pay you. So what then?
All right, so let me deal with that. So the first place I would go with that is, as a nonprofit, you're in a whole different information return. So you don't even do a tax return, you do an information return, a 990 that you turn in. And so inside of that 990, there is an income statement. There's income revenue, because we're not talking income, but there's revenues and then there's expenses. And so you're gonna have, under your expenses, an allowance for bad debt. And so where your allowance for bad debt account exists, that's where you would end up taking that would have been revenue and then subtracting it as an expense from your overall revenue picture. Does that make sense?
Yes, yes, of course.
Yeah.
All
So,
right.
but you wouldn't be on the Schedule F. You all would be on the 990.
Yes, on the 990, the postcard, or 990N. Okay, I just wanted to bring that up because I didn't know if there are others that are, nonprofits that would be doing that, and wanted to, post that question. Thank you so much.
You're welcome. And I know last time we did this, one of the callers were talking, I'm saying callers like we're on a radio show, forgive me, y'all. But one of the people in the meeting had mentioned that they had a farm and they were doing it as a nonprofit. And is it possible to do it that way and still retain your nonprofit status? And so we were talking about, a nonprofit doesn't mean that you can't sell things or do like what would normally be viewed as profit generating activities, as long as you don't retain a profit, as long as you take the excess that's left over after you zero out your expenses and then redistribute that into the business or into the social purpose of the farm.
Yeah.
And so a farm, anything can really exist as a nonprofit. It's depending on what you do with the excess left over after you zero out the expenses. Helps you to retain that nonprofit status.
Yeah, exactly. Thank you so much. Very well answered. Thank you.
You're welcome.
And then Daz asked in the comments, she said, well, what if it was in that scenario? What if it was for profit and you sent out an invoice and you didn't get paid off of it?
So again, that you would expense that as a bad debt. Maybe let me get back on that one because I'm not 100% sure on the F. So on the Schedule C, I know for certain that you can take an allowance for bad debts. But on the Schedule F, there may be some different rules. And again, I want to be transparent. I don't do the Schedule F as much as I do the Schedule C. I do some Fs, and that's why we have Brittany here to back me up. I don't know, Brittany, if you have some thoughts on that.
Yeah, to be honest, I always do the cash method and kind of encourage people to do cash method for that reason exactly. When the money comes in, I say the money came in, and when the money goes out, I say the money went out. It's just easier to track in some ways. And again, those accrual methods or the accrual method, those benefits, which definitely exist in a lot of businesses and even in larger farms, I just have found that they don't really apply to smaller farms. And so when you're doing the cash method, you don't really even have to worry about that. But if you are doing accrual and you do have that bad debt, as far as I know, there isn't a specific line related to it. So it would probably go under one of the expenses. But yeah, I'm with you exactly.
And to your point, there's always like a other category under expenses, and we just have to put it on that category, and then they'll ask for a description and a separate schedule of what your other expenses were. Those could always cause prompt questions later. Don't necessarily mean that having them ask questions, having IRS ask questions mean that you did something wrong or that you did something that's going to be disallowed. Sometimes just additional clarity is required. It's outside of the algorithm. Most of the times they're processing these electronically, and there's something that can, determine if something's off and it needs to be reviewed by a person. So yeah, Daz, let me let's get back with a right answer on that. Let's put a pin in that, and let me circle back to you with a correct answer after I do some more research.
Okay, but GMAC, okay, you just introduced two terms. You said Schedule F, Schedule C. What are those two different things?
Yeah, so the Schedule F is the profit and loss for a farmer. Schedule C is profit and loss for business, all other kinds of business except for farming. Farming gets a special schedule because there are special things that occur in a farmer's income situation, such as there's certain loans that a farmer can list as income, where a loan is generally not income. A loan is invisible on the tax return usually, but for certain types of loans per the Schedule F, it's listed as income. So I think the Schedule F was created to, make sure that the special benefits and things that are available to farmers are addressed on a separate, tax form. So when I'm saying Schedule F, that's what I'm talking about. Farmers form, and then Schedule C is the one that's just general business profit and loss statement.
What dictates, I'm sorry, hands raised, Ben. I'm sorry, Ben. I want to be in order.
No, you are in order. Thank you. We acknowledge your hand.
Thank you. I want to ask, well, what constitutes whether or not we are a farm yet? If we are a community garden, so we have 2 community gardens. So, and then we're trying to work to get the other one joined together to start the 3rd one. But what constitutes, or what would say to the government on a Schedule F that we are a legitimate farm? Okay, so like we have, everything as far as the business, the state, of course, is under a nonprofit and all. But if we were to choose to do a Schedule F to be able to get in line with those benefits that may come down the line, or say, for instance, if farmers take a hit in some way, there are a lot of other things that they can do to help farmers, to help their farms or get them equipment or whatever. What constitutes that? And not just speaking for myself, but even people that have larger farms that I know that want to join Keep Growing Detroit and want to get into this, but have that fear of, okay, am I going to be able to maintain it? Or are there any incentives? I think that's the word I'm looking for, that would be out there for farmers. Where would they look and say, oh yeah, Holy Grounds is a legitimate farm?
So, publication 225 has this definition out there that's sort of like, it's the test of whether or not you are a farm, if you can answer these questions as yes. But so 2 things. One, as a nonprofit, even though you're conducting farming activity as your nonprofit activity, you are outside of the Schedule F realm. You are in a place where your activities have to be captured through the 990 reporting system. And in that way, to my knowledge, which is not the full knowledge of all to be known. So I want to qualify that statement with that and say, to my knowledge, you don't have access to the special benefits of the Schedule F if you're going under the nonprofit tax exempt way of conducting your business affairs, because there are benefits that maybe you trade off those for what you could get as a Schedule F for-profit farmer.
Okay, and thanks, Daz. Daz put on there the 501c5 as opposed to the C3. Okay, thank you. I'll look into that.
Okay, there's another hand up. Travis Peters. Travis, are you on mute?
Hey, how you doing, brother?
I'm great. How are you?
Good, and everyone else. Thanks. I had a question regarding the Schedule F and C. So use myself as an example. For the profits and losses, expenses, recording your farm specifics, Schedule F. Now, what if I also operate mobile delivery, CSA, and other projects under the farm business, but same LLC, but different works off the farm, if you get the gist?
Are they farm related activities, or are they a different profit producing activity altogether?
I guess irrigation, construction, other things like that, delivery, would that be considered directly attached to a farm?
So here's the definition, right? Businesses that cultivate, operate, or manage a farm for profit and it includes livestock, dairy, poultry, fish, fruit, truck farms. So I think if you are like doing infrastructure work that maybe support agriculture, that probably is not a Schedule F farm activity. It's a for-profit activity. You know what I mean? It's related, but it's in a different for-profit realm, which would probably put it on the Schedule C.
So you can, under the same tax years, use both schedules? Is that allowed?
Oh yeah, absolutely. Okay. So sometimes you have to, because if you're doing something in two different realms, then you have to account for it in the proper spot.
Okay, under the same 10 and business though, correct?
They're all under the same tax ID number?
Yes.
Yeah, I would say so. Yeah, okay. You would probably need a Schedule F and a Schedule C for the separate activities that relate to the, those separate things. All of your farm stuff where it's like really clear cut, this is my farm.
Yes.
And then the other things that kind of like maybe support agriculture, but are like more, that sound like more construction, more like tending toward that field, then I would see those probably residing on the Schedule C.
I appreciate that. Thank you for the clarity.
No doubt, because where we're going next is going to illuminate that even more, right? Farm income. Farm income is defined as sales from farm products, rents, agricultural program payments, income from cooperatives, cancellation of debt, income from other sources, income averaging for farmers. So, I mean, farm income is very, very specific. Like it's got to fall into these categories. And I'm sure for most folks, it's just sales of farm products. Some of these other things are very like niche type activities. Income from cooperatives. I'm sure that there's some people here that are participating in co-ops. As a co-op owner, you receive income from the operation of it. And so that income is designated as farm income when it's farming activity that generates it from the co-op. Cancellation of debt. If you owe someone and they gave you a cancellation of debt, generally, the best example of this that I can use, it doesn't relate to farming, but it's one that may illuminate what's meant by this. When the foreclosure crisis happened, many people received a cancellation of debt 1099. The difference between what was owed on the mortgage and what was the value of the full value of the mortgage that was left over. Let me make sure I'm saying this right. The difference of what wasn't paid yet, the debt, was sent out on a 1099. That cancellation of debt had to be included as income on a person's tax return. So if they still owed like $30,000, that $30,000 then came on a 1099 and had to be treated as income. So if something like that were to happen in the farm world, it would be treated as income. If a debt got canceled for some reason, it would be treated as income. Income from other sources, that leaves some questions, even in my mind. What are the other sources? What are the possibilities? Is it possible that these other sources, maybe that Travis is talking about, may be applicable here? And before we get off of this call, I'd like to pull up the 225 and just look at that. But I'll put a pin in that for the moment. Income averaging for farmers. Again, this is a very specific thing where it's dealing with income averaging, which is on the Schedule J. It's an additional schedule where you go by, what your previous income was over a number of years, you average it out and use that as your income. We can get into that more too, but for the basic application for your Schedule F, these are the income items that are allowed. Generally sales, rents, agricultural program payments. Is this where that grant, Brittany, conversation should come in under agricultural program payments?
Yeah, we can for sure. So the EQIP grant, which is the grant people might receive to put up high tunnels, that is going to come in the form of an agricultural program payment. You'll get a 1099 from the USDA, and you do have to report that income. However, and I'm going to post this in the chat because honestly, it's not cut and dry. This is one of those instances where it's all in the publication 225, but you kind of got to read through it. So I kind of made this little cheat sheet. So if this applies to you, definitely take a look at that. But you're receiving the income, right? But you're also buying something. So the question is, do those things cancel out? Is the, $9,000 I get from the USDA to build this tunnel, and then I use it to build the tunnel, is that expense canceled out by the payment? And the answer is most of the time, yes. You can say that you got the income and then either as a Section 179 expense, which I'm sure Greg will get into, or as just kind of your standard deduction, you can take or depreciate the cost of the tunnel, no big deal. But for that to be true, you have to make more than 4 times what the payment was. So if you're a small farm and you make $2,000 and then you get a $9,000 grant, the USDA does not let you fully depreciate the entirety of the tunnel. So again, if this applies to you, click on that link I just put in the chat, and it breaks it down, and you can maybe see kind of where you fit into that. But you do, no matter what, have to declare that as income. It's just a matter of how much you actually get to depreciate later on, if that makes sense.
Okay. So if I heard you right, Brittany, you're saying that unless you make 4 times the amount of the grant payment, so in the instance of a $9,000 grant payment, if you don't make $36,000, then you only get to depreciate the amount of the income that you actually made.
Unfortunately, not quite that easy. It's like
okay.
An equation.
Okay.
Like
There's a calculation.
There's a calculation. Exactly.
That has to be made.
Mm-hmm.
And then that then determines the amount of the full 9 that you can actually depreciate. But it's not cut and dry that you just get to depreciate the whole 9.
That's right.
Unless you have 4 times. Wow, that's interesting.
Yeah, it's not ideal.
If you had 4 times, if you had 36,000, would you need 9? Anyway, that's another question.
Right. Those aren't the people who need it.
But that again, so these are the things that are good to know in this space. So income, expenses. This is the part to me that's the most important. And there's a couple new changes in the 2022 year, so I want to share them with you. For the first time in my experience, I'm seeing this half a year difference in mileage. So for through June, you get 58.5 cents a mile, but July through December is 62.5 cents a mile. So this year on your tax return, be aware of that slight change. That 4 cents for the half of the year could make a big difference depending on how much mileage you calculate. Also, 100% business meal deduction. Generally, business meals are limited to 50% and 80%. But this year, based on there's a new tax law that came out. I don't remember the exact name of it, but when we pull up the 225, it's there. 100% of your business meals can be deducted instead of just a percentage. So that's an important note. Business use of home deduction limit. There is a limit to how much business use of home that you can deduct. However, most folks don't exceed it. And the reality is this is a part that a lot of people also miss out on, taking advantage of expenses that they're paying that they don't necessarily see as an expense. For instance, if you're using a room in your home or a few rooms in your home, that's a part of your farm operation. And so your home expenses that relate to those rooms now become expenses of your farm. So if you could take the square footage of those rooms and then take the square footage of your entire property and then get the percentage of what those expenses are, you can subtract that monthly total for the year, from your total income. So a quick example of that is to say, if you had 1,000 square foot home and you were using 200 square feet of your house for your farm business, then 20% of your expenses for your home are now farm expenses. So if your rent is $800 a month, then 20% of that, or $200 a month, is now an expense. That's a legitimate farm expense. The utility costs associated with that, the percentage of it, et cetera, et cetera. The expenses of that space that you use can then become expenses of the farm. So this is a spot in the tax world that I noticed that many of my clients don't think about or consider, or even feel even funny about, like, really? Should I be doing that? Like, well, you certainly should. If this is your home that you're using to run the farm with, like, this is an expense. So don't miss those expenses.
Does that include garage?
T, that is a very good question. Does that include garage?
Cause I got about 5 kayaks in my garage. I don't know. Does that include for my business?
Do you have a payment, like a house payment, that you from a mortgage or something like that?
Absolutely.
I mean, so technically your garage is a part of what you're paying for, as well as the entire parcel, right, of the property. So it would be hard to say that it didn't include the garage, but the question becomes, how do you figure out what percentage of your expense, your overall housing expense, is the garage, right? So if the garage is really like, I don't know. Let's look more into that, because I don't want to give some hasty advice. My gut is that yes, you should be able to take it, but I'd like to find out exactly if there's a rule specifically prohibiting additional structures like garages and sheds, where then you would be getting into some trouble. But if there's not, then just from a strict logic perspective, if that's part of what you're paying for, is figure out what percentage of that overall 100% that is, maybe a small percent, and then allocate accordingly.
And then Haley took the question out of my mouth, like, what if you're growing on land that you own? So is that, so say I'm growing in my backyard or something like that, or if I have a small greenhouse in the backyard or something like that, that I'm doing transplants. There's a couple scenarios in the chat. Is that a calculation of that?
So the land, I think, is where we will get outside of the home. The home is the word that is the hinge in all of this. And I think that they're speaking of specifically the house itself. If we start talking about the land around the house, I don't know if it exists inside of that definition of home. But let's look into it. This is it's a good conversation to explore further. And that's just the thing with taxes, right? Like, nobody can memorize the whole 2 big books of 1,500 pages each tax code, but you can look through it and you can find, like, oh wow, I didn't even know this is how this is defined. So then there's some gray there where I can actually maybe define it this way. And so that's it's worth investigating.
And I want to add that on the Schedule F under farm expenses, there's a place for utilities and there's a place for taxes, which includes property taxes. So what you guys are talking about in terms of, a vacant lot next to you paying property taxes on that, water you're using to water your garden, I don't necessarily think that that's going to fall under that business use of home, but that doesn't mean you're not going to be able to deduct it. If you're measuring how much water you're using out in the garden, you can put that under utilities as an expense. If you know what you're paying on property taxes on the lot next door, definitely put that under taxes. In terms of using a percentage of the property tax because it's your backyard, I'm not so sure about that per se. That's something we should definitely look more into, but just because we can't use it under this use of home, there's still a place to deduct it. So we're not missing out on those deductions.
Yeah, and another question I had was, so for the mileage, what are you using to say, like in the case of an audit, how do you differentiate between your business mileage and your personal mileage?
Yeah, so I mean, you should keep a mileage log. Thank you for bringing that up. You should keep a mileage log. If you're transporting your goods, you know, any driving that you do on behalf of the farm, whether it's picking up things, dropping things off, transporting people, any driving that you do related to the farm, keep a mileage log. And then all of the miles that are farm related, you would then allocate to these amounts for the time periods here. And again, that mileage log will also help you to know which ones you need to be multiplying by 58.5 and which ones by 62.5 based on when they occurred in the year. And then totaling that and, you know, deducting it from your overall income. Yeah.
Okay, and then before we go on, we had one question in the chat from Tracy, I think.
Okay.
There's a couple of questions. I think we got to all of them. If we didn't, feel free to come off of mute. But Tracy said she had a question about insurance for small farmers and if it's deductible. My lots are 3 blocks away from my home, so they're totally separate.
Yeah, there's an insurance line item on the schedule F, so that's certainly something to be deducted. Yeah. Startup costs. Do not take this cost out because this is another one of those spots where people may not realize, you know, you should be reducing your income by the amount it took to get this thing going. The purchase of a bunch of bins, or I don't know, because I'm not a farmer, but when you have to buy a bunch of things to tool up to start a business, the startup costs should certainly. There's a limit. You can only take so much. I believe it's 15,000. But I won't don't quote me on that. That might not be the exact number. I know it's 15,000 in some other schedules. But the bottom line is, don't miss out on your startup costs. Oftentimes, a startup cost will generate a loss in the beginning, as it should. That loss will subtract from your overall tax liability and put you in a position to receive a higher refund if you had a refund coming, which will assist you in all of that additional investment that you put into the farm. Another thing that I want to also illuminate as an expense that sort of gets hidden is owner labor. You might not have defined the pay rate for yourself, but the work that you are putting into the farm has a value and can be quantified and then listed as an expense. This is a non-cash expense, but it's an expense just the same. Similar to your mileage log, you should strive to keep a log under your record keeping system of the days and times that you worked in the farm operation and at what rate you're paying yourself for that work. And then you tabulate those expenses and make sure that you subtract them from the overall income. Cannot deduct personal expenses, crop loss, and dues. So these are some things that you can't subtract from. Of course, personal expenses, but I mean, I just have to say it, right? If you buy yourself a coat, well, here, if you buy yourself a coat to farm in the winter, that's a farm expense. Now, if you buy yourself a coat to go to a party, that's not necessarily a farm coat, and then that's a personal expense. But the ideal is that personal expenses, crop loss. I don't know if you all are aware of this. I was surprised to learn that crop loss is not something that you can deduct as an expense. And then dues, unless it's very specific to industry organizations, then you can't really deduct your dues that you pay to belong to clubs, other types of groups like that. I see Georgia has her hand up.
Only yes, Gregory. Thank you so much. Just because I invited one of my really good friends on, and he has a farm, and he has like 7 horses, and he has a great farm, and so I want to connect him with UT, but he may have some questions. I had a question you said about in kind, and I know that this gentleman, he literally does all the work, the hay lifting, the getting all this stuff and everything for all the horses and doing the farm and everything. So is there a percentage or an amount that we have that we can ascertain the in kind is listed at right now? And would that pertain to working the farm?
I would say, look and survey the labor rates for the type of work that you're doing, and then pay yourself an industry standard rate, so that the IRS doesn't come back and say that you were taking advantage of them. You were charging $100 an hour for working the farm, and the industry standard might be $35 an hour for a farmer. I'm just making up numbers, but what I'm getting at is just utilize some best practice clearinghouse information, Bureau of Labor Statistics or somebody like that, to find out what the standard rates are, and then certainly allocate your time multiplied by that rate to the expense column and subtract it.
Okay, so we don't have to file file a 1099 for those services, or because you're paying yourself, or because then we have to do a 1096. So is there something?
So because you didn't actually pay yourself, you're now just taking the expense of what that labor would be and subtracting it, from the income. It wasn't a cash event. So it doesn't prompt the need for 1099/1096 filing. But
okay,
it is a and the 225 publication gets into this as a like a pro tip. It said, do not miss your owner labor.
Awesome. Okay.
It's just something that people just, they're in love with what they do. They're doing it mostly as a passion. And so they don't even think that paying themselves is even a consideration. It doesn't even cross many people's mind.
Right. Okay. Thank you. Okay. I won't bother you guys no more. Thank you. This is great.
No. Listen, that's why we're here.
Absolutely.
Georgia,
Absolutely. No bother at all. There's a few things in the chat. I just want to make sure we didn't miss anything before we go on. Just look real quick. Okay, Deetra said, does that apply to just club or producer organizations or farmer specific cooperatives? Is that the dues part maybe you were talking about? And then there's a couple of hands raised.
Sure, that dues thing is, so at the end, I have it where I wanted to pull up the publication 225 and sort of go through a few things. So let's make sure we go and look at that at the end of the presentation. I'll pull up the publication 225 and we'll read through that language together.
And it's good to be, not good to be operating as a loss, because then you are not on.
You don't want to miss, right? You don't want to miss your loss when you have one, because then it will assist you potentially. If you had a refund coming, it could decrease your tax liability, increase your tax refund. I see Daryl Jones has a hand.
I'm the friend with the horses. Good evening, everyone. Blessed by the best, getting better by the minute. Thank you for the information you're sharing. It is awesome. George is always after me, and I'm glad she made me aware of this tonight. My question to you is, for me, it's always been a big question in how to get started, particularly with horses. Some of what I want to do is nonprofit based, like helping children get involved with animals, and the therapeutic effect it brings to all humans, actually. So, you know, I didn't know if there was like either an organization or a step-by-step publication that can help in that avenue or not.
In establishing a nonprofit?
Both profit and nonprofit. So, for instance, like if I wanted to, I'm always being asked to board someone's horse, which I always turn down just because I don't want the headache of it. People want access to their animals 24 hours a day. I ain't dealing with that. But and then there's a whole bunch of aspects to it that can be troubling in terms of how, you know, people come and they feed the horses things that, you know, more than what they should be fed, all kind of issues. But I really, there are people that I know very well, and I would consider, you know, keeping their animals for them and housing their animals for them, feeding their animals for them. And I just wasn't sure about, so that wouldn't fall into the nonprofit category. But I also would like to have a nonprofit arm, again, just to kind of expose, not all children actually, and all humans find a therapeutic effect. A lot of ex-veterans find a lot of healing from PTSD, things of that nature. So these are all areas that I've always wanted to get in, but just didn't know how to proceed.
Gotcha. So if you are interested in like establishing a nonprofit, that's something that I could help you with. And we could talk outside of this about it. I could either point you into some directions or do the whole thing for you or anything in between that. And then as it relates to the for-profit part of it, I don't know the way that you currently have your business set up, if it's currently as a for-profit or if it's something else, if it's not set up, it's just something that you're doing. But in both cases, I think that we could benefit from a conversation offline. I could get more into the details of what you have and then offer some information to you and maybe point a few directions towards you.
That's great. What's the best way to get in touch with you?
I'll put my information up at the end. I'll have my phone and email and all of that.
Great. Thank you so much. I appreciate your time.
No problem.
And then also, Mr. Jones, I was going to say, we went through, this is part 3 of the business series. In the first series, we went through business structure. And we can also send you that that recording, because he kind of went through, you know, why you would start the different types, you know what I mean? Like what would prompt you to start each one, whether it's LLC or a nonprofit. So I just wanted to offer that also.
Please provide that. This is so right on time and so on target that I probably won't sleep tonight. If you send it to me tonight, I'll be up watching.
Awesome. I can put that in the chat in a sec.
That'd be awesome. Thank you so much. You guys, I can't tell you how great this is. Thanks, Georgia.
You can pay us back in horse rides. We'll be out there.
I know that's right. I was just getting ready to say, you know, over at one of my favorite nonprofits on the east side, we're doing work with horses. I think they call it equine therapy or something like that. We had children riding horses, and yeah, I'd like to talk to you more about that.
Definitely. All payments of horse rides are paid between December and March. So come on out, bring your coat and your snow gear, and we'll hook you up.
Beautiful.
I'm just teasing. I'm just teasing, but I'm out there.
I like the wintertime. That sounds like fun to me.
I'm out there every day. So, and there won't be any long lines in the wintertime. Don't worry. Let me let you get back to what you're doing.
Okay. All right. So one of my favorite expenses that you could take advantage of, again, is depreciation. Depreciation is another one of these no cash event expenses when you purchase a capital expense. So there's a difference between a expense of the business that is something that's happening for the current tax period. And then there's a difference between that and a capital expense. A capital expense is something that you will take advantage of and get the use of over a long period of time. So when Brittany was talking about the high tunnel and the portion of it that you can take depreciation expense against, this is what we're talking about, something that like a big tractor or excavator or some kind of tool that you pay $20,000 or $30,000 for, you don't take this as an expense against the income all at once, because in many instances, this would upend the financial statement. It would cause you probably to have a huge loss that would then, you know, sort of put you in a very advantageous position compared to what the IRS might want you to be in. Now, let me say this. For the last few years, because of the pandemic, bonus depreciation has been a thing, meaning generally you have to depreciate things at rates that apply to them. So a residential property is depreciated at 27.5 years, meaning that you take the whole total of it, you divide it by 27.5, and you take that little piece minus the salvage value every year as an expense. Bonus depreciation for the last few years, to sort of help people through the pandemic, is allowing you to take larger chunks of that depreciation, up to 100%, depending on your situation, of the expense. So in fact, it gives you the ability to sort of expense the whole thing up front. In some instances, it makes sense to do that. In other instances, it makes sense to hold on to that depreciation expense and take it over the longer haul. But that's something for, you know, a person to discuss with their tax professional as they make that strategy for themselves of what to do with that or not. But there are options around depreciation. But depreciation is an expense that comes to you over time. You don't have to pay for it in order to get access to it. So it can generally be beneficial when you're trying to reduce your exposure to income.
I did not know that. That's good. So that's what Brittany was talking about, taking the full depreciation off of the Hoop House Award. That's dope. And then quick question, and Haley, I'll get to you also. Quick question. This piece this is for Schedule F, but is this similar to Schedule C? Because we may have people on the call that are not necessarily like claiming as a farm business, but maybe having a like some of the scenarios we brought up in the first class, like maybe have a herb business or something like that, or something what Travis said, like a service entity to do raised beds or something like that, or irrigation. Is this information like pretty similar to the Schedule C, or is there anything that's completely different?
Yes, it's pretty similar. I mean, it's income statement basically is you subtracting the income from the expenses to get a net profit or loss. Farm, the Schedule F has very specific things for the farm that relates to like those agricultural payments and other things that only pertain to farmers. But with the exception of that, it's 90% a Schedule C.
Okay. And then Haley, you had a question still. You had your hand raised, sorry.
Yeah. So just about the depreciation stuff. I file a Schedule F and a Schedule C usually. And and I usually just muddle through and do it by myself, but I've never been able to figure out the depreciation stuff. And I don't have like any super large expenses, that are like that, like a $10,000 expense or something, but I don't really understand if there's anywhere else on the tax form other than the depreciation section for stuff like, let's say like a rototiller that costs $200, or like a power tool that costs $200, like any kind of tools or like equipment. It seems like that's supposed to go in the depreciation section. Is that true? And I guess
yes.
if so, do you...
So depreciation, $200 is an arguable amount where you could choose to depreciate it if you wanted, but the expense, the depreciation expense from that would be very low. It may be more to your advantage to just take the full amount of the expense. Depreciation is usually coming in when you're dealing with expenses that are into the thousands of dollars for things that you're purchasing that you'll be using over a long period of time. But the argument about long period of time applies through what you're describing in rototillers and other tools. And so even though the depreciation expense for each individual one would be a proportionally small number, that doesn't mean that you don't do it. It's a little bit more work, but it could be worth it, you know, to do it in that way.
Right. But if I decided not to bother, like, is there another line to even put it on, or do you just put it as other?
Yeah, I would just take an expense like maybe from farm supplies, farm equipment or something like that, and expense it in a line item that you call that or something like that.
Okay. And do you think I could, like, what if I have been doing this for years and I just don't write stuff off because I don't know where to put it? Can I write it off now, or can I like say that is it just too late?
Unfortunately, yeah, because that time has passed. It has to be done in the period. And that's what we're talking about, this cash versus accrual.
Okay.
You know what I mean? Like once the period is closed, that's it. Now you could do it and then they come back and produce receipts and they show it in another period, then, you know,
Right.
it'll be disallowed. So
Right. Okay. But
okay.
also with the accrual wouldn't help with that because you already didn't report it at the right time.
Right. And yeah, it's kind of like, you know, I was just bringing up accrual because that's when we're talking about how sticky the IRS is about this tax period. Like that's why.
Yeah, sorry. I said accrual, but I meant depreciation. Like,
okay, no,
like
but I get what you're saying. The bottom line is that time is passed. If it's not within the calendar year, then that expense opportunity has passed.
Okay, thanks.
And I also want to, not to add a complicating factor, but under depreciation, there's also something called the Section 179 expense. So if you do have a big purchase that you don't want to put under expenses, but you do want to take it all at once, you can use the depreciation form, but do a Section 179 expense. And the reason I bring that up is because for a lot of people under the EQIP grant, that's a financially beneficial thing to do because you get all that money up front. If you then depreciate it year after year, high tunnels are 10 years. So you have to account and pay taxes on all that income in year one. And you do get to then deduct it over 10 years. But for a lot of people, they would rather not pay any taxes on the income in year one, just take the whole expense right away. That wouldn't fall under your like expenses. There's no line item for high tunnels, right? You still have to include it as a depreciable asset, but you're saying, I don't want to depreciate it. I want to take it all at once. And I think the like amount of money you're allowed to do that up to is like $1 million. And so I don't think it applies to anyone here. But if you do have those larger expenses and you don't really know where to put them, but you just want to take them all at once, that's another thing you can look into that is pretty self-explanatory and pretty straightforward, is that Section 179 expense.
Thanks, Brittany, for that. And so now to get into the Schedule F, the form itself, it's just 2 pages. It's pretty straightforward. We talked about the line items that you get into with the farm income. And I'm pulling up the form to show it to you all, but in reality, if you were to use a, you know, online tax preparation, do-it-yourself program, it would probably ask you questions and then go back and populate this form for you. But I just want to show you what the form looks like and how it's filled in. But you would put the name, you know, of yourself or company, social security number or tax ID number, principal, crop, or activity. And then you would enter from this code here of activities. You'll find the list on page 2 at the bottom of what the different 6-digit codes that you put in B are. And then you get into the accounting method. Right up front, they want to know if it's going to be cash or accrual, because in completing the Schedule F, if you have farm income that you want to report using the cash method, you do so in Part 1. However, if you wanted to report your income using the accrual method, then you would be using Part 3 on page 2. And so on my screen, I have you all right here. So I don't know if y'all can see the full thing where it says part 3, because I don't know what y'all see.
We can see it.
You can see, okay, thank you. So part 2, whether you cash or accrual, this is where the expenses are listed here. And so see number 32, where we got other expenses specified. This is where things that don't exist inside of these categories could be listed and discussed. And at the bottom line of this whole thing, you figure out whether or not there was an income or a loss from the total activities on line number 34. And then this number then goes into your 1040 for your personal return to inform whether or not there's income to add or a loss to subtract from your tax liability. And that's the Schedule F, basically, in a nutshell. So at this point, if there's no question specifically on this, I want to pull up the 225 publication and go back and pull out like information from specific questions we talked about earlier.
Can I just quickly ask if owner labor is just an other expense, or is
Yeah, I
it?
will put it under other.
Okay.
But let me see. Let me quickly check. Yeah, car and truck, employee benefit, fertilizer, labor hired. Mm-hmm. Yeah, that appears to be something.
It's almost
that
like they don't want you to take it.
Yeah. Yeah, that's something that will be specified under other. And that's a great segue, in fact, for me to go to the 225 publication, and let's pull that up. Quickly, before I do that, I want to list my contact information, make it available to everybody here. I don't know if folks can take a screenshot of this, or I don't know if a better way to do it, but there's my email address, my cell phone number, our website, our office location, and I'll put this up another time. But before I go out of this completely, I just wanted to put that up. And now I want to switch over to where I got the 225 publication. So under expenses, I think my son got something to say.
Right. Hey, Moyo.
You want to let y'all know about the expenses that he's had to incur with his farm.
You're still on the contact page if you were trying to show us something.
Am I? Oh, it didn't switch to.
It hasn't, no, it hasn't switched.
Okay, let me stop sharing and share again.
Okay.
All right, can you see this now?
Yes. Mm-hmm.
Okay, all right. So I'm looking at farm expenses. Again, this standard mileage rate. Here is this new thing where we got 58.5 cents for part of the year. And then for July through December, the rate is 62.5 cents. So this is a new thing just for this year. And again, the meal expense deduction based on the Taxpayer Certainty and Disaster Tax Relief Act. There's been a number of acts that have come out since COVID in an attempt to provide some economic stimulus through the tax returns. But 100% of the business meals are deductible for the tax period running through 2023. So not just this year, at the end of this year, but all next year, the same thing will apply. So just be aware that be in a position to take advantage of that for what it's worth. And then I want to look at where I was reading about owner labor. And then with these, I don't know if you all use this trick, but generally, if I'm looking at a PDF, you can, well, maybe since I'm in Zoom, I can do it here. You can do a Control F and oh, 52. Wow, why won't it just give me the whole thing? And search, but that's not really working for me either.
I was wondering if the owner labor would be actually under hired labor. I mean, they're hiring themselves.
So I remember seeing it in a spot where it was pointing out expenses that are generally missed. I'm gonna skip too quick through it. Did I go too fast again? Okay. Piecework, non-deductible pay, credit.
What were some of the other questions we were going back to also?
Yeah. Sure, yeah, I don't want to use up the tablet for that.
No, feel free, but I was just trying to remember what else we were gonna go back and look at. There was a couple of questions that came up.
Haley raised her hand.
Thanks.
Haley,
Yeah, I wanted to press you a little bit on the just on the subject of like operating at a loss, because there's people have been saying in the chat like, wow, we're all operating at a loss. Because I think for a lot of us, you know, this is like some serious labor of love kind of thing. And once you count your own labor, you're operating at a loss. And like speaking for myself, I have farm labor and then other labor, but it's all self-employment labor. So I think like I don't have any nobody else hires me, I guess. So like just on a personal level, like is there any like danger or disadvantage to operating at a loss year after year? Like
yes, unfortunately there is. They will classify your farm operation as a hobby if you take a loss 3 out of 5 years.
right.
So in the 5-year period, 2 of those years have to be at least a small profit in order for it to remain as something that you can claim expenses against on your tax return.
Right. Otherwise you would just have to count the income, but not the expenses.
Right, yeah.
Okay.
There is a small exception to that 3 out of 5 rule, which is that if you can prove you're drastically like growing your business, like if the first year, you know, you lose $50 and then the second year you lose $100, then the third year you lose $50, but you've made, you know, $10,000 more. That was a poor way of saying it. But if your income, if the gap between your income and your expenses stays small, but your income is going up drastically with your expenses, and you can prove that, they heighten that gap and you actually can't claim a loss, you know, 3 out of 7 years. So there is a little bit of leeway with that, especially if you can prove that you're growing your business and you're not just like making $1,000 every year and, you know, conveniently spending $1,010 or so, you know, something like that. That's like obviously a hobby farm. So there is a small exception available if you can prove you're growing your business. But yeah, so I have never taken that owner expense. I'm actually curious to see it in the 225. Because I obviously would have a huge loss as well.
All right.
And I have paid other labor and I always include that labor. But ultimately for me, when my business operates at a profit, that profit gets carried on to my 1040 eventually. And that's what I'm paying taxes on as, you know, my personal income, even though I maybe didn't necessarily like transfer that money into my account and pay myself in that way. But
you're still paying taxes on it.
You're still paying taxes on it. Yeah.
Yeah, no, and that's a good point. I mean, I think many people, if you are taking a loss, you know, that's a great point. You don't really want to be making yourself have more of a loss than you already have if you already are fighting to continue to be looked at as a farm for tax purposes, because the IRS is not sympathetic to what it takes to do all of that. It's strictly business, and if it's not going to be something that is going to work in their favor and it's year after year benefiting individuals, then they're going to, you know what I mean, exempt you from that activity eventually.
Right. Yeah, and that's somebody brought up earlier on about expenses late in the year. If I'm buying seeds for next year, if I'm buying, a rototiller for next year, and that can factor in, if you need to have a small income, maybe push that expense into next year so that you still get to have the expense, but you still have the benefit of having a slight income in this year. And then the hope is obviously that you're going to make more money next year, so that expense can then be kind of, deferred that way, I guess. For small purchases, obviously, it's maybe not worth doing the math on, but if you are purchasing a big tunnel or a tiller or something, and you're looking at it in December, it is worth asking, what if I push this purchase off 2 weeks? Will that benefit me in the long run? And the answer might be yeah.
Yeah, I feel like my mind is playing tricks on me. Like I was just looking at this owner labor thing yesterday, and as I look here today, I'm clueless as to where exactly it was in here, but I'll continue to glance for it. In the meantime, I don't want to use up all our time on that either. So I want to encourage, if there were other parts that I said we should look at on the 225, and you all remember what they were, let me know so I can navigate over to those, and then when we will circle back to this another before it's all over with. And what time is this over to?
We would like to stay under 2 hours.
Okay.
So, yeah, there was, if there's no other questions, there was some broader questions that I wanted to circle back. Any questions about anything we've discussed so far? If not, Linnell had a question actually from another class that we could do.
Okay, I'm open to that.
Okay, Linnell, do you want to come off of mute? Because I see your question was long, if you're still there. It was regarding LC3s or L3C.
Hi guys. Thank you so much for the classes. I really learned a lot. Greg, you were talking in the first class when you were going through the scenarios. I can't remember what scenario 3 was, but you mentioned the LC3 tax structure briefly, and then you guys kind of decided to go with a nonprofit for the example. And I'm just wondering if you could talk about a little bit more about the LC3 tax structure. I know that federally you file as a LLC, but so right. What are like the benefits and what are the drawbacks of having that tax structure? And why would somebody choose? I chose it. I have one. Now I'm a little bit struggling with it. So just want to learn a little bit more.
So you and many other people, that it was advertised as a hybrid between the LLC and the nonprofit, with the ability to like be able to get grants and things like that as a for-profit business. But it's difficult. Many people have been finding difficulty in receiving grants with an L3C. And it's you are not able to become tax exempt. And so I think some of the confusion initially was that you would be able to be tax exempt and you would be able to function similar to a nonprofit 501c3. But for taxes, as you said, you have to file it as an LLC. The other L in the L3C is just low income. They still haven't defined what that low income number is. So it's a low income limited liability company, and your income, it has to be classified as low for you to continue to be one, and you have to carry out a social purpose and all that stuff. So yeah, I don't really know the benefits. Again, the benefits were supposed to be that you can get grants. And there are some grants that are available to L3Cs, but I've heard a lot more people with L3Cs have difficulty in finding grants than people who said, man, this L3C is the best thing that ever happened to me.
Right, agreed. And it's also like an extra, like you can in kind with it, but it's like an extra step in that you first have to you have to let people know what it is, and then you have to kind of tell them how their business is able to contribute to yours. And it's just like, it's definitely difficult. I call myself saving a step from building a board, but in the long run, doesn't seem like I did. So what would you recommend? Like, should I change my tax structure?
What type of business are you into?
Yeah, I identified with scenario 3, and now I can't remember what it is, but basically I have, I got five lots from the land bank. And I'm just getting started with building a neighborhood garden. I don't know if I'm going to continue to try to market produce or just have people kind of hang out, or maybe rent space, or I'm not sure yet. I'm thinking about doing a lot of restructuring now, actually. So, yeah.
Well, I mean, maybe there's some discussion me and you can have offline. I don't want to get into too long of a conversation, but it sounds like I hear some for-profit kind of elements in there. I also hear some possibilities for some nonprofit stuff. But once you make that choice between one or the other, it's very different worlds for tax and all of the rest of that. So
yeah,
it's just something you have to really think.
Okay, thank you so much. I will definitely hit you up offline and see for some services as well. Thank you.
All right, and I'll say this. When I say that you all can consult with me offline, I don't charge for our initial consultation. So don't think that as soon as you call me, you got to have your credit card ready, and then I start charging in that moment. I mean, we can have a conversation. I can get an understanding of what your situation is and share some information with you. And then if I provide services, then we can get into that. I just want to clarify that it's not going to be a thing where you automatically incur a bill when you give me a call. Yeah, I'm puzzled on this owner labor thing because I was so happy that they actually put that in there, and now I'm looking all over the place and can't find it. But
was it in farm employment?
Say that one more time.
Was it in farm employment? There's a section that talks about like hiring your family and stuff.
I was looking at that. I don't remember where I saw it. It just jumped out at me when I was preparing my PowerPoint, and I said, "Oh man, let me make sure that I bring this into the conversation."
So Greg, while you look for a second, I just want to say, talking about the different tax structures, what you do with that Schedule F will depend on what your farm is. So if you're an LLC, but there's just one of you, then it's kind of just it's going right on your 1040. But if you're an LLC and you're a partnership, or you're in one of the other tax brackets, that Schedule F doesn't go on your 1040. It's going to go somewhere else. So speaking personally, yeah, we're a partnership. So it's me and my partner. I do my Schedule F, and then I actually have to file what's called a 1065. So it's like a farm. Yeah, it's like a farm 1040 kind of business 1040. And then from there, I divvy out the either the expense or the profit or the loss to all of the different members. So just kind of keep that in mind. Once you fill out the Schedule F, you're not done. Obviously, there's like a lot more forms, and depending on who you are and how you're filing, the Schedule F might end up somewhere else, but how you're filling it out isn't going to change whether you're an LLC or an L3C or just an individual or anything like that. Or if you don't even have, a formal thing and it's just your side hustle and you're making good money, those are all going to look a little different after it's filled out.
Yeah, thank you, Brittany, for bringing that up. When you have a partnership, then you file a 1065 return, and your Schedule F certainly has to go in with that 1065 filing. The 1120 is the form for corporations, and then 1120S is for subchapter S corporations. Certain LLCs elect to get that treatment, and so then their Schedule Fs then accompany that. But it can end up a number of different places. The average person who's just a do-it-yourself or a one-person operation, they're gonna end up on a 1040 with the Schedule F, and they won't have any other form. But yeah, different situations, absolutely.
Yeah, and with that, if you are an individual and it's going on your 1040, then you are paying self-employment tax on it. You're not paying the same tax that you'd pay if you're getting like a W-2 or the K-1, which is the partnership form. So just if that money does come through and you are making a profit, you are going to end up paying the self-employment tax on it, just like the Schedule C. So that's just another kind of comparison between the two.
Yeah,
which is like 15% or something crazy.
yeah, it's like, yeah, it's 15 point something. So you don't want to have to pay that. If you don't have to pay that, take advantage of all expenses possible to reduce that.
Is it possible that, like, if you're doing it as a single member LLC and it's passing through in that way, and maybe it's different if you're in a partnership, like maybe maybe you would claim the owner labor in a different way in a partnership, maybe?
No, I mean, so okay, so then this is how that goes. You end up with the Schedule F that goes to the 1065 for the partnership. Then the partnership then distributes a K-1 statement that then has to go to the personal return of the partners. And so that income is still going to be whatever the net of it boils down to be after you divvy it between the people who it has to get split between. It still comes into your personal return as self-employment income.
Okay.
Yeah.
So if it's coming to you, then it wouldn't be coming twice then.
No.
Right, so.
Yeah, so I don't know. I can't find this piece about this owner labor, but I'll stay on the hunt for that. But there were
that's gonna bother you all night.
Yes, no, it's gonna nag me until I can find it and send it to you. But there were some things that were here that I wanted to share some examples. So maybe we can do one or two of those.
That sounds good. And then I'll send this recording to YouTube, and then I'll send it out probably tomorrow or the day after that. And so if you did come up with some information, we could include it in a follow-up email.
Okay. Sweet. Let's see. So renting and leasing, lease or purchase. So example, you lease a new farm equipment from a dealer who both sells and leases. The agreement includes an option to purchase the equipment for a specified price. The lease payments and the specified option price equal the sales price of the equipment plus interest. Under the agreement, you are responsible for maintenance, repairs, and the risk of loss. For federal income tax purpose, the agreement is a conditional sales contract. You can't deduct any of the lease payments as rent. You can deduct interest, repairs, insurance, depreciation, and other expenses related to the equipment. So again, in this instance, on a lease of farm equipment, there's a limit where you can't deduct any of the lease payments, but you can deduct the interest that is a part of that payment, the repairs, the insurance, the depreciation, and any other expenses related to the equipment. So like, you know, maintenance, the repairs is already there, but any other expenses related to the equipment, I don't know what other expenses could exist outside of these, but apparently you can deduct them. Let's see.
I had a quick question about income that needs to be reported. So I would imagine that even if you're a for-profit farm, kind of in our urban environment, you may get a gift of something. Like I kind of think about the Black Farmer Land Fund, and I talked to an accountant, and they said that we didn't have, that the person wouldn't have to file on taxes, but maybe you can. But so something like the Black Farmer Land Fund, where you're getting a capital investment into your project, or say you have some kind of small business grant, or you know, say somebody gifts you with a pile of compost, you know, I mean, I don't know, you know what I mean? Like how would you, at what point do you need to report things and like?
Got you.
Yeah.
That's a good question. So let's use the Black Farmer Land Fund, for example. You all give grants to farmers, but you don't 1099 those farmers, right?
Correct. And we don't give money directly to them. We pay, like we will wire the money directly to the land bank.
Who they're benefiting from. Okay. So then basically, got it. So in that way, then they're not really receiving any income.
But they're receiving a land, you know what I mean?
A benefit, right? A benefit. So, but the real catch is if you all have a tax responsibility for reporting it. If you did, and then you had to report it, then they would have to report it. And so that's really like the test. So if I have to report that, you know, I paid you via 1096, then you have to report that you got paid using the 1099. You know what I mean? Like, that's the way it goes. Like, if I have the responsibility of reporting the payment, then you will have the responsibility of reporting receiving that payment.
Mm-hmm.
You know what I mean?
Yeah.
So that's how you know. So like, if somebody gives you some compost, I don't think that that's something that they have to report to the IRS. That they gave a gift of compost, and then requiring a reporting from the person who received it. But yeah, definitely, if money is given over $600 is the threshold amount per the IRS rules. Anything over $600 technically should be reported by the person who gave it, so that the recipient would then need to report receiving it.
Even if it's not money per se, it's goods, or you know what I mean?
Yeah.
Somebody donates
that's a good question. I mean, there's all kind of gray in between the black and the white, and that's something for further research and investigation.
I'm gonna set up my free 15-minute consultation with you.
Yeah,
which I do all the time.
Yeah, I would be interested in looking into that though. That's interesting because yeah, that I'll leave it there. That's interesting.
Yeah, I think a good rule of thumb is if you get a 1099, report it. If you don't, don't.
I've heard it said less is more.
Yeah. Yep. I'm asking also on a personal note with Detroit Mobile Kayak. I got a gift of several kayaks, and I'm like, I didn't get any paperwork with it. I just got the gifts. I don't know. Is that a gift?
Yeah.
Is that reported?
Yeah,
like,
I mean,
or we should talk offline because this will be recorded.
Yeah. Yeah, we'll talk.
I didn't say Detroit Mobile Kayak. I said
Right.
no.
I'm not like 100% confident on this or anything, but I think when it's a gift, it's a gift. You know, like there's a section on the Schedule F that's like if people pay you in goods, you're supposed to count it. Like if I sell somebody produce and they pay me in pigs or something, it's supposed to be income. But I think a gift is a gift, and you don't have to pay taxes on that gift unless it's worth so much money that you have to pay taxes on it. But not that I feel like an authority on that, but that's what I think.
Yeah.
Yeah, gifts are interesting. Gifts get like very interpretive and all of that kind of stuff. So I mean, a lot of gray.
Yeah. Okay. That was one question I had wrote down for myself. Any other questions before we get off the line? We had a great discussion. I really didn't think we would be talking this long, honestly. But that was a lot of information that you covered. Any questions as it relates to the Schedule C or the Schedule F? The Schedule C, we didn't go as much in depth with, so I just want to make space for those folks who might have another type of small business. Any questions? Schedule C, Schedule F, accrual versus cash. What else did we cover? Okay, all right, family. Well, if there's no, Haley, did you
I
want?
have a question.
Okay, jump in there.
No, that was me, Georgia. Hi, yeah, one question. This may be for you, T. If we have something that, as far as being grown in Michigan or grown in Detroit, and then we actually use the item to make something to sell, you know what I mean? Instead of it just being a fruit or vegetable, but we make a dish or make something to sell from it. Is that still okay? Still considered grown in? And if we have a loss on that, we would add that into our tax structure. Correct, Greg? So that's for T, would that still be grown in? And then for Gregory and Brittany, would that still be added into our losses?
I believe as long as you're operating under cottage food law, which like there's caps on how much money you're making, how much product you're producing, all that stuff. But if you're making, jars of jam from raspberries that you're growing and you're operating under those limits, then you're still including that income on Schedule F because it's still farm income. But if you exceed those, so if you start a jam business and you're selling thousands of jars of jams every year, then that's not really your farm anymore. Then that becomes its own business. But cottage food law is what you'd want to look into and see those limits. But Greg, I don't know, you got to back me up, but I'm pretty sure as long as you're under those limits, then it's still Schedule F income.
Okay.
Yeah, Georgia, I think I heard you saying that if you had expenses for preparing the food and it caused a loss, would that be?
Yes. Okay. Right.
Yeah. So again, I think what Brittany is saying is a great place to look for that. Because preparing the food now starts to sound like it may be getting outside of the farm, and it may be taking you into some Schedule C activity possibly. But there are rules out there that are, set up to deal with that. And I don't know the farm tax world as well as I know the for-profit and not-profit business tax world. So I would hesitate to answer that definitively, but I would say it sounds like to me that preparation of food is pulling you into a more for-profit type of activity.
Okay.
That I would see on the Schedule C.
Okay. Thank you both. Appreciate everything. Phenomenal presentation, guys. Thank you.
No question. Thank you all for your questions. They help me to continue to see the areas that we need to continue to study and learn so we can provide great service. And so thank you, Brittany, for the backup. Thank you, T, for tagging me into this meeting.
Can we get the contact information to you, or T, are you gonna send that out on the email? Because my call dropped a couple times, so I missed the chat. My chat restarted.
I can put that back on the screen.
Oh, thank you. Awesome. Thank you.
No, might as well get on in the meeting. You don't want to be in the meeting, but you want to be in the meeting.
All right, family. Well, you have a lot of thanks going on in the chat. So thanks for coming, Greg and Brittany. You both are a wealth of information. Really appreciate you guys having you guys in community with us so that we can elevate together, you know. So I appreciate you guys joining tonight. Brittany put her contact also in the chat, and Greg's is on the screen here. So I'll give you a quick second to take a picture of that with your phone or take a screenshot. Yeah, it's a great class, guys. Thanks so much.
Right on.
All right.
All right. Well, thank you all. Much success to you all in the upcoming tax year. May you get all of the money that the IRS has to give.
All right. All right. Peace. Peace, family.
Peace. Peace.
Thank you all. Bye. Thanks, T. You're awesome.
Thanks, Georgia. You too.